Okay, let's just dive right in. Picture this, a global financial trading floor. But instead of that usual chaos, shouting traders, frantic signals, it's almost silent. The only sound is the hum of servers. And those servers are making decisions that once took humans minutes, now happening in like milliseconds.
And the engines making those split-second decisions? They're not people. They're these opaque, black box AI models. We can see what they do, sure, but we can't always see why they do it. And that leads to the big question, the one that's probably keeping regulators up at night. What happens if all those different AIs are secretly reading from the exact same playbook?
And this isn't some far-off science fiction scenario. Nope. This is a very real and rapidly emerging feature of today's financial system. So in this explainer, we're going to unpack how AI and the coming wave of quantum technologies are being flagged as major new financial risks by some of the world's top regulators.
We're going to cover the new kinds of risk that AI brings to the table, what a supercharged flash crash could look like, and trust me, it's scary. We'll get into the hidden threats from a concentrated tech supply chain, the ticking clock that is quantum computing, how regulators are basically scrambling to keep up, and finally, what this all means for you, the key takeaway on this new form of financial fragility.
So first up, AI's new financial risk. Look, AI is already everywhere in finance, from pricing models and credit decisions to detecting fraud. But it's in the world of high-speed trading algorithms where this concentration creates a brand new kind of vulnerability. And the folks whose job it is to worry about the stability of the entire system, yeah, they are taking notice. The Bank of England's Financial Policy Committee put it, well, pretty bluntly. They've warned that the widespread use of similar AI models could push traders, or let's be real, the algorithms themselves, to act in this perfect, dangerous unison. It's a herd behavior that could dramatically crank up market volatility.
And it's not just them. This isn't some niche concern. The International Monetary Fund, the IMF, has echoed this exact same warning. They see a really clear risk that AI could amplify shocks that ripple through the market, basically with all the machines reacting to the same signal at the exact same time.
So how does this actually happen? Well, the Bank for International Settlements really hits the nail on the head. As they point out, AI creates correlated bets across tons of different firms. And that dynamic, that is the exact kind of thing that can turn a small, totally manageable shock into a full-blown systemic crisis. So you see how all this builds into a very real, very concrete threat, the supercharged flash crash. Now, you might remember the whole flash crash idea from years back. The thing is, today's AI can react way faster and much more aggressively than the algorithms that caused those earlier events. And this breaks down that chain reaction perfectly. Step 1. A bunch of independent AI models all detect the same market signal. Step 2. They all react in milliseconds. Step 3. A massive flood of correlated, totally automated sell orders hits the market all at once. And Step 4. That sudden one-sided pressure ignites a huge price dislocation. It's basically a flash crash on steroids.
Now, the risk here isn't just about fast trading. There are these other, subtler, second-order threats that are frankly just as worrying. These are the hidden risks that could cascade across the entire financial system before anyone even knows what's happening.
You see, the crucial point is how the actual nature of risk is changing. We're moving from a world where the main worry was an individual human error, one trader messing up, leading to a localized failure at one bank, to a world where a single model error can cause a systemic cascade across tons of institutions all at once.
So why is this risk so systemic now? Well, it boils down to 3 key reasons. First, you've got vendor concentration. A whole lot of banks and funds are all relying on the same handful of cloud providers and AI model vendors. Second, there's data poisoning. If a widely used dataset is flawed or even maliciously corrupted, that one mistake can spread through dozens of institutions at the same time. And finally, opaque governance. Like we said, many of these models are black boxes, which makes it incredibly difficult to audit them or even understand why they're making the decisions they're making.
Okay, let's totally shift gears for a second and talk about a different, longer-term threat, quantum computing. Now, this isn't about market crashes. This is about the fundamental security of our financial data, and you should really think of it as a ticking clock.
So the big threat is that a powerful quantum computer will one day be able to just break the encryption that protects pretty much everything today. The solution is something called post-quantum cryptography, or PQC, basically brand new encryption standards built to stand up against a quantum attack.
But here's the immediate problem, what experts are calling the capture now, decrypt later threat. Malicious actors can steal huge amounts of encrypted financial data today. They can't read it yet, of course, but they can just store it. Then, years from now, once a powerful quantum computer is finally built, they can go back and decrypt all that sensitive data they captured. And that makes the move to these new security standards incredibly urgent.
So with all these risks piling up, how in the world are the planet's financial watchdogs supposed to respond? Well, global bodies like the BIS and national regulators are definitely moving, but you get the sense they're playing a serious game of catch-up.
They're recommending a pretty clear set of actions for financial firms. Things like running stress tests specifically designed for AI failures, mapping out their technology supply chains to find those concentration risks we talked about, and creating mandatory governance standards for the highest risk models, and of course prioritizing that big migration to post-quantum encryption.
But the core challenge is still there. The speed at which firms are adopting these powerful new technologies is it's far outpacing the speed at which new rules and oversight can be developed. And this gap, the one between innovation and regulation, that's what's keeping policymakers up at night.
So, let's bring all this together. What's the key takeaway for you? In this new tech-driven financial world, what should you actually be watching for?
If you're an investor, the big one is to be aware of concentration risk. Start asking questions about the funds or firms you're invested in. How heavily do they rely on just a few AI models or a single cloud provider for their most important operations?
If you work in finance or tech, the mandate is pretty clear. You have to prioritize robust model governance and just relentless testing. And on the quantum side, you need to start building a cryptographic inventory now to get ready for that post-quantum migration. You have to know what data needs protecting before it's too late.
And if you're someone who follows policy, you'll want to watch this space very closely. You should expect to see regulators push for much tougher stress tests that specifically target technology failures. And be on the lookout for new rules that require firms to disclose way more about how they're using AI and other complex models.
Ultimately, we're left with this central paradox. These incredible new technologies promise huge gains in efficiency, smarter models, faster markets, better decisions. But at the same time, they create brand new and potentially much more dangerous forms of fragility.
The question really isn't if these technologies will reshape finance. They already have. The real question is whether our institutions and our regulations can reshape themselves fast enough to keep up. Because if they can't, the next crisis might not arrive with a loud bang of human misjudgment, but with the silent, perfect synchrony of machines all acting on the exact same flawed signal.